The real estate market has been pretty crazy over the past couple of months, really ramping up in the second half of 2020 and well now in the first half of 2021. And the reason for this is pretty much what happened last year over the course of the pandemic with major business shutdowns across North America. Both Canada and the United States decided to lower the underlying interest rate to near rock bottom levels with the intention of stimulating the economy further by increased borrowing, right? So with lower interest rates, this makes it cheaper for borrowers to essentially access capital with hopefully the intention of reinvesting it and pouring it back into the economy. But on the flip side, this has resulted in skyrocketing property prices over the past year or so because there's increased demand and stable or even lowered inventory right now because everything is getting snatched up, and whatever does end up going to market pretty much inevitably goes into either a bidding war or a multiple offer territory. I mean, just take a look at some of these recent headlines. It's a complete frenzy and really makes you wonder when the euphoria is going to hit a brick wall. But with that said, as many of you are aware, I am also a real estate investor because I like to diversify my capital into multiple different asset classes that are also maybe outside of the stock market. And with real estate, I'm able to leverage up my capital and access other wealth building benefits, which is one of the main reasons why over the past 2 years, I have purchased multiple rental properties and have subsequently also sold off a couple. And to be fully honest, real estate investing has kind of changed my life over the past 2 years as I've been able to buy properties under market value. That's pretty much my strategy, and we'll be talking about that later on in the video. But as a result of increased housing prices as well as forced appreciation that I put into these properties, this has had a significant impact on increasing my net worth. And with that said, I'm currently in the process of buying 2 new rental properties, which might sound somewhat weird considering the fact that I just mentioned that the market is so hot. So why in the world would I be buying a property in this hot market? But this really comes down to the strategy that I deploy and I want to talk about in today's video. Because in my view, there is always going to be opportunities to be had. You just have to really look for them and be patient. So this is really where my investing strategy and the way I analyze properties comes into play and is paramount to the success of my overall real estate investing strategy. I cannot stress enough how important it is to have a strategy. And I know for a lot of viewers, this might sound boring and might sound like I'm a broken record, but just like with stock market investing, if you don't have a strategy for your own situation, then as soon as something happens out of the ordinary, you're going to be like a chicken with its head cut off and not know what to do and might actually even end up acting out of emotion, which is the last thing that you want to mix with investing. All right, so let's get started. Straight off the bat, if you're newer to real estate investing, I'm going to recommend that you pick up a copy of this book right here called The Real Estate Retirement Plan by Calum Ross. And no, I'm not affiliated with this book or the author or whatnot, but it's a book that really helped me out when I started real estate investing, really to understand the various concepts about why real estate investing is so powerful with its multiple different building blocks. And I know what you're probably thinking, retirement plan. Griffin, why are we talking about retirement? I'm 18 years old. I want to be investing in real estate. But really, trust me on this one. This is a great book to get started. It's not going to go crazy in depth or whatnot, but it's going to change your mindset on real estate investing and how you can make money through this asset class. And really, for the $15 investment that it's going to cost you to buy this book and the couple of hours to read it, the return on investment is going to be basically infinite. This book contains literally hundreds of golden nuggets of information that are going to help you become a better real estate investor and understand the asset class. But the 4 main elements are really simple to understand, being debt pay down. So every single month when you're paying the mortgage payments, you're essentially building more equity in the building. And well, actually, side note, it's the tenants that are paying down the mortgage and building equity for you. The second one being cash flow. So cash flow is also very simple. It's essentially the money that's left over each month from your income after all the expenses have been paid on the property. Moving on, we also have actual natural appreciation or forced appreciation of the property. And once again, this is also pretty simple to understand. It's how much the property increasing in value over time as they do naturally or through strategic renovations and raising the rents. This will also have an impact on the market value. And then finally, the 4th main building block with real estate investing is the tax advantages that you're going to have through investing in this asset class, including capital gains, deduction of all the expenses of the property, and so forth. The book also made me realize that every property is pretty much its own little business and that it's going to have its own set of income each month or yearly, and it's also going to have its own set of monthly expenses, including things like the mortgage, the insurance, the taxes, etc. So you need to treat every single property that you're purchasing as its own little business. Let's now speak about my property investing strategy and how it has changed over the course of owning property in these past 2 years. Let me first start off by mentioning the fact that equity and investing in property for creating equity and gaining equity over time is really where it's at for creating larger sums of capital with property. Because when I was first starting out, I was investing for cash flows more. That's what I was looking for, is creating monthly cash flows that I could then potentially use to pay for my living expenses. And although this is a strategy that can work, typically it's going to require more doors in your portfolio. And by doors, I mean properties. In order to generate enough cash flow each month to really make a dent in your own personal expenses, right? And also keep in mind that cash flow is fully added to your total taxable income. And so for this reason, it's raising your tax bill at the end of the year. And over the course of owning property that does cash flow, I've kind of realized that I would sooner just leave that cash flow in the account in order to account for potential repairs that might come up, or even just rolling into new properties, because this is going to allow my portfolio to have more cash in it, and then I can reinvest into more properties or whatever else I'm looking to invest in. Because here's what I failed to realize when I was first starting out and looking to invest strictly for cash flows, is that when you're investing for cash flows, yes, this can help you out on a month-to-month basis with paying for your expenses. However, when you are first starting out with real estate investing, capital and your liquidity is everything. This is the most important thing, because with real estate, it's a game of capital essentially. How much money you have to invest and leverage up to then flip into more properties, etc. And with equity, this allows you a lot more flexibility with your deals and the money that you have built into your properties. Let me expand a little bit on this. So let's say you buy a property under market value, and then over the course of 2 years, it goes up 20%, let's say. Well, you've created a spread of equity that you can do multiple things with. You could either sell the property and realize a nice profit, or you could also pull out a home equity line of credit, which is essentially a loan that is backed with the house in question. So for this reason, the interest rate on it is typically a lot lower than with a personal loan. You can also cash out refinance the place. So you can refinance the property at a higher market value and pull out the difference. These are just a couple of things that equity allows you to do. And so really, even with the first properties that I had purchased a couple of years back now, and I had cash flows on my mind at the time of buying them, well, over the course of time that I held those properties with their values going up in the market, I've now sort of realized that the bigger money is to be made in the equity portion of your real estate investing, because this capital allows you a lot more flexibility with where you're going to invest next and create larger chunks of capital in a shorter time frame if you buy a strategic property that can go up in value in a shorter period of time. And let's also not forget the fact that with mortgage debt, you're able to access both cheap as well as stable leverage. Whereas let's say investing in the stock market, you're pretty much just creating a return on the capital from your pocket that's invested in the market. Whereas with real estate, you are able to leverage up your money 20 to 5 times essentially, depending on your down payment. And then you're creating a return on the entirety of the invested capital. As a quick example here, let's say you invested $20,000 of your own money into the stock market and managed to generate a 10% return in 1 year. Well, great, you have $2,000 more in your stock portfolio. On the flip side, if you took that $20,000, invested it into a property that was $100,000 and borrowed $80K at an 80-20 loan, and then also managed to still create a 10% return on that asset, well, now you've not generated $2,000, you have made $10,000 in that year, because you're making the return on the entirety of the asset's value. And this might only be on the appreciation portion of that property, right? You might also have some forced appreciation in there, as well as cash flows, which are also adding on to your total return on that invested capital. And also keep in mind with that example that the $80,000 you borrowed from the bank is typically going to be at a low interest rate, especially right now. My most recent purchase is a 3-year variable mortgage at 1.6% interest, which by the way is tax deductible anyways, the interest on the mortgage payment. And anyways, I wouldn't purchase a property that didn't have enough revenues right off the bat to fully cover expenses. So you're somewhat hedged in that way. Now, without a doubt, this has become quite a bit more difficult over the past year because property values have risen so dramatically. However, I'm telling you, there still are deals to be had. You just need to be patient and put in multiple offers on properties. I mean, realistically, I've put in over a dozen offers on rental properties in the past couple of months, most of which all get rejected. However, I always maintain the strategy, and I'll never buy a property if I'm stretching the numbers to make it work for some reason. That just doesn't make sense. With real estate, it is all about the numbers, so it needs to make fiscal sense before you actually purchase the property. Always keep in mind that this is one of the worst things that you can do is buying a property where you've stretched the numbers for a couple of main reasons. First of all, if your cash flow is just tight on the actual income versus the expenses of the property, meaning you're pretty much flush each month, every single time something arises in the property, you're going to be paying out of your own pocket to make those repairs. Another thing is that when you're first starting out and you're buying property, you're tying up a lot of your available debt capacity into that one single building. So this is going to be really important in order to buy multiple different properties. When you go to the bank and you already have a couple properties under your belt, they're going to take this into account in the amount that they're now willing to provide you. So if you have all of your debt tied up in bad deals, well, this is going to be very detrimental on the capital that you have available to invest with and your leverage potential. Let's now circle back a little bit to my strategy and how it's changed over time. So I was saying earlier that I was first investing kind of for cash flow, and now I pretty much just buy properties on the basis that I'll be able to do some strategic renovations and raise the market value. So there are two types of appreciation though that you encounter with real estate investing. You have, first of all, organic or natural appreciation, which is just the overall natural appreciation in the asset's value over the course of time that you're holding it. Most of the time in most markets, real estate is going to go up maybe 2 to 5% depending on the market per year. What we're seeing right now is kind of completely out of the ordinary. In Ottawa, where I live, well, actually on the other side of the river, but even in Gatineau, we're seeing properties go up 25-30% in value, or even selling for hundreds of thousands of dollars above market value. Now, that is sort of inflated organic appreciation, if I could say it that way. But that is the first form of appreciation. And this is something that I don't really bank on when I'm buying a property. This is just icing on the cake. Now, the second form of appreciation is called forced appreciation, where I've mentioned it a couple of times, but you're essentially doing strategic renovations in order to raise the market value and the appeal of the property, and then also potentially, in the case of a rental property, raising the rents. Because with a rental property, the rents and the income coming in also has a direct value on the market value of the house, instead of just, let's say, a single family home where it's more based on emotion. Okay, so you're probably wondering though, what are the elements that Griffin looks for when he's looking at properties and analyzing the numbers? So the first thing is going to be the purchase price of the property. Pretty simple, but the purchase price is arguably the most important element in the entire process of owning rental properties and selling them later on at a profit. Because if you overpaid for the property from day one, you're either going to be flush with the market value or even underwater if the market goes down a little bit. So always remember that you never want to buy a rental property or an investment property out of emotion and overpay for X reason. You want to make sure that it makes fiscal sense, and if it doesn't, don't overstretch yourself. Just cut your losses essentially, or there won't even be any losses. Just don't buy that property if it doesn't make fiscal sense. The second main element that I look for when I'm analyzing rental properties is an estimate of the total repair cost, because the repairs are essentially what's going to be the difference between your purchase price as well as the after repair value of the property, which we'll be speaking about in a couple of seconds. But the repairs are going to be, well, I would recommend that if you're first starting out, the repairs are just aesthetic strictly. So I'm talking paint, I'm talking potentially trim, just smaller things that actually make a huge difference, but that aren't going to be above your level of expertise when you're first starting out, because trust me, funds dry up quickly when you're doing a home renovation or any property renovation. So I would say stick to something that is relatively easy to do and that you can do yourself, because when you're first starting out, you won't also have a bunch of money to pay a team to do all the renovations for you. And by the way, this is exactly what I did over the past 2 years. I didn't have money when I was first starting out to pay a team to go in and do renovations. I was doing it myself. It wasn't fun or pretty, but it allowed me to put some sweat equity into the property and raise the value as a result. Moving on to the third element that I take into account here is one that we just touched upon, and that is the after repair value, ARV for short, of the property. And this is very simply the value of the property after you're done doing the renovations, and is where you're going to make your money between that split of the property value that you purchased it for and what you put into the property. Now, when you're first starting out, it can be very difficult and maybe intimidating to estimate the after repair value. So this is why it is critical that you get a competent real estate agent that is potentially, hopefully also a real estate investor themselves, so they can give you a more accurate price point for what they think the property will be worth after. Okay, so another element that I've had quite a few people ask me is whether or not I take into account the age of a property. And this can be a factor that I consider. However, it's not at the forefront of what I'm going to consider on a property if it makes fiscal sense. And anyways, I'm going to do an inspection on it. So if the inspection passes, to me, it doesn't really matter. This is really one of those elements though, where it's case by case and it's hard to give a blanket statement. Okay, so next up we have the rents versus the expenses of the property, and as a result, whether or not there is monthly cash flow being thrown off of the property, along with whether or not there is ability to raise the rent through either negotiating with your tenants, or let's say one of the units is vacant. This is going to give you a lot of leverage to bring that unit back up to market rents. Because as I mentioned earlier, unlike with a single family home, for example, where the market value is also highly tied to emotion and what buyers are willing to pay for it, well, in regards to a rental property, the actual financials are highly important because, like I said, it's a little business in and of itself. So there are some different ratios and metrics that real estate investors take into account. So for example, a really simple one here is the annual revenue multiple. And this is going to vary greatly depending on the market that you're in. In my market, for example, a duplex that needs a lot more renovation is probably going to go for 12x yearly revenues estimate. And this is actually up from around a year and a half ago where it was 10x revenue multiples. Now, a really, let's say a brand new duplex, that could go all the way up to 16 times or even more than that, the yearly revenue. So this is something that you can use as an investor also to estimate how much you think a property is worth. And then after taking into consideration higher rents, what it could be worth in the open market. Again, though, all of this is very much a gray area, and I cannot stress enough how important it is to have a competent real estate agent as well as a competent mortgage broker that can guide you throughout this process. Now, another element that's more of a qualitative element is just the vibe that I get when I'm walking and touring the property on a visit, and the vibe that I get from the tenants. Trust me, this is one of the most important things that you can do as a new landlord is don't underestimate or just basically not consider the tenants and what you're seeing from your own eyes when you're doing a walking visit or tour of the place. Your tenants are essentially the clients in a sense of the business, which is this property. So yeah, this is very much a time when you want to assess what you're seeing in a property and make a decision based on that. Now, I titled this video How I Analyze Rental Properties in This Market. So what would this video be if we didn't dive into an Excel spreadsheet or whatnot and have a breakdown of how I calculate the expenses as well as the income, cash flow, return on equity, and all of that. So I'm going to attach down below to this video the Excel spreadsheet that I personally use. It's really simple, but if you want to use it yourself, it's down below and you can access it. All right, so that pretty well wraps up today's video on how I go about analyzing rental properties and what my strategy has since evolved into in